Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. What are genuine savings? Many first home buyers can often get caught out with the concept of genuine savings. When applying for a home loan, having a deposit that you've saved is something that most lenders like to see. When you're able to save, it demonstrates that you are able to handle your finances, which makes your character something that a bank would likely lend money to, or would like to lend money to. If you are looking to borrow more than 90% of the value of the property, then genuine savings become even more important. If you don't have enough money in savings to use as a deposit, then there are loan products that you can still access. The most obvious is a guarantor loan, which is when another person, usually your parents, guarantee the loan. There are even some instances where a person has paid rent for a long period of time and a lender will consider that as savings. If you have equity in another property, this is often able to be considered as a deposit as well. However, what actually constitutes genuine savings is often not straightforward, and it is usually wise to have a discussion with your mortgage broker early on about your situation. So the first thing to consider is using short-term windfalls. Often, home buyers might have received a large sum of money that they would like to use as a deposit. That might be something like an inheritance, a gift from a parent or from their parents, a tax refund, or the proceeds from the sale of an asset such as a car. The way lenders assess genuine savings is based on how long the money has been sitting in your account. Therefore, you might be able to simply leave the money in your account and add to it for a period of, say, 3 months, and then the lender could very well consider that as genuine savings. The longer that you have the money in your account, the better. And secondly, waiting to buy. If you are in a position where you can wait a few months after receiving a significant sum of money, you could potentially use those funds as a deposit that will put you in a far better position. You will likely be able to access a wider range of lenders. If you can contribute more by way of savings, you could pay a lower rate of lender's mortgage insurance or LMI, or the risk fees, for example. And that usually occurs once the loan starts going above 80% LVR or loan to value ratio. And you will likely be able to access a wider range of loan products with higher LVRs. Recently, the federal government has introduced the First Home Loan Deposit Scheme and First Home Buyers Assistance Scheme, which allows first home buyers the opportunity to purchase a home with as little as 5% in genuine savings and not be required to pay LMI. In this case, the money you have saved on the LMI could well be used as a deposit. There are a number of ways that home buyers are able to increase their genuine savings in the eyes of a lender. Again, the best thing to do is to contact your mortgage broker so they can assess your situation and match you with the right lender and loan product. And that concludes this episode of the CostofCarry podcast. Thank you all for tuning in, and I'll see you in the next episode.